You're listening to Ask the Expert on Sprott Money News.
Well, greetings once again from Sprott Money News and SprottMoney.com. This is your Ask the Expert segment for August 2017. I'm your host, Craig Hemke, and joining us this month is Nomi Prins. Nomi is a renowned journalist, author, and speaker. At one time, she worked for firms such as Goldman Sachs, Bear Stearns, and Lehman Brothers. Now she's, like I said, primarily an author. Her most recent book came out in 2014 with the title All the President's Bankers. And her next book will come out in May of 2018 with a title of Collusion and a subtitle of How Central Bankers Rigged the World. It's a great pleasure to visit with Nomi. Nomi, thank you so much for visiting with us today.
Thank you very much, Craig.
And before we get started, just a reminder, these Ask the Expert segments are brought to you by Sprott Money. We deal with mints around the world to bring you the highest quality bullion and numismatics. Visit our site at SprottMoney.com to shop now. Nomi, as I was explaining earlier, these questions have all been submitted by Sprott Money customers over the course of the last couple of weeks. And this is a chance for them to interact with you and hit you with them and get your response. If you're ready, should we just dive right in?
Yeah, absolutely. Thank you.
All right, I've got 7 of them, and here's the first. Question is, U.S. Treasury bonds are the pillar of the financial system globally. Why is debt considered to be an asset, and might these bonds ever be replaced by something else?
That's a really good question. One of the reasons in general that government debt is considered an important asset is because it can actually be traded and it's liquid enough to be utilized to either raise money or to post as collateral for other forms of capital. So they have an intrinsic benefit in the financial system between central banks, between large private multinational banks, and so forth from that perspective itself. They also have the idea behind them that they have this implicit guarantee by their various governments. Now, of course, the U.S. Treasury bond is not a AAA bond like it once was. That changed a few years ago. But it still has the implicit guarantee that it will not default. So even though right now it barely pays any interest, so from a return perspective, it's not particularly lucrative, it does have the idea behind it that because of this implicit guarantee, it's not going to lose its value. So the $100 or the $1,000 or the $1 million invested in Treasury bonds isn't going to go away. So that's what maintains its attractiveness as an asset. But again, from the perspective of a return, right now, in terms of interest rate return, yield return, it's not particularly lucrative because it's not really providing very much of a return because of the global policy of effectively zero interest rate money at the front end of the yield curve and not very much higher at the back end.
And Nomi, the second part of that question is, can Treasury bonds ever be replaced, or are they just simply part of the system in the whole dollar reserve currency system?
Yeah, in the current monetary system we have, the international monetary system, because the dollar is the major reserve currency and because the U.S. is currently the most powerful country from a lot of perspectives in the world, there is a necessity for central banks and then the private banks within their own domestic arenas to use and have the availability to use the U.S. Treasury bond, U.S. Treasuries to balance their payments, to use in terms of potential liquidity emergencies or other types of financial crises that might come up as liquidity mechanism, and also because in general governments, the U.S. As well as other major governments throughout the world happen to use their bond system, their Treasury bond system to finance the discrepancy between their own domestic balance of payments. So the revenues that come in, say, from taxes versus the payments that the U.S. government might need to make to run the country. And so from a two-pronged perspective, that debt, because we don't have a balance of payments that's positive, needs to be issued to make up that gap in the United States. And because the dollar is a prevalent currency and because U.S. Treasuries are the most liquid form of moving central bank policies around that currency relationship and around the U.S. They're not going away anytime soon. And in particular, the last 10 years, we've had an extraordinary increase in public debt and U.S. Treasury debt to the extent that we're well over 100% relative to GDP, which is different and which is, I think, here to stay for a number of years.
All right, let's move on to the second question. Again, this Sprott Money customer notes that you recently served on a committee formed by Senator Bernie Sanders that kind of dealt with the idea of being able to reform the Federal Reserve System. And the question is, can the Federal Reserve System be reformed, or must it instead be replaced and maybe go back to some type of sound money standard?
That's a really excellent question. That committee, it was the Federal Reserve Advisory Committee, was created, I think, in 2012. We don't actively meet anymore, but the idea of that was the idea of auditing what it is they do, how it is they do it, and whether there's any external parameters that can be utilized to, sort of influence or control, or at least evaluate how they do what they do, because right now it's pretty much a three-pronged approach. And the second element in that is to look at how effective the Federal Reserve had been in doing two of its primary functions, or two of its stated primary functions in the Federal Reserve Act in 1913, and that's to maintain price stability, and it's also to regulate the banking system. And as we know from the financial crisis and also what happened throughout the world, the Federal Reserve in particular did a lousy job at regulating the risks that were coming into the whole entire system from the major private banks. And not only did it do a very bad job of detecting risks that were coming out, it actually did the opposite, which was sort of deflect other people, whether it was in Congress or whether it was journalists or whether it was fund managers, concerns about what was happening with respect to risk in the banking system in the middle part of the 2000s. So it failed on that regard. And from the standpoint of monetary policy, and now we're several years from that point of the advisory committee, and also almost 10 years from the financial crisis, it's pursuit of policy with absolutely no limitations from the outside of printing money, buying securities. It stopped buying, but it pretty much has a $4.5 trillion book. If you look at central banks across the world, of which the Fed propelled this policy, the Bank of Japan, the European Central Bank, and the Federal Reserve together, throwing the Bank of England, you're looking at a $14 trillion book of assets as part of this monetary policy of quantitative easing and of keeping rates low, which has other ramifications in terms of creating asset bubbles, not having enough return for pensioners or insurance companies or just people saving money in banks. So it's had major ramifications. So the idea is that a good, effective way to run a global monetary and financial system? And I'd say the proof is that it's not a particularly good way. If those policies were able to really affect change in terms of stabilizing the financial system that caused the crisis, for example, 10 years ago, we wouldn't have needed them for 10 years. And what we're seeing right now is that there's no particular end in sight to them. So the fact that there's no external sort of any kind of jurisdiction that tells the Fed what to do, that it's pretty much a make it up as you go, and in the last 10 years, very unprecedented, unconventional policy of easing and printing money and stimulating artificially various markets and private banks, that is actually creating more risk in the world and reducing risk in the world. And so having another type of a system where there's an external framework, an external benchmark, that at least pulls them into some sort of a coordinated approach, that would actually be a better way of maintaining stability, whether that's a standard currency approach or whatever that might be.
Okay, Nomi, that brings us to the third question, and that's an excellent segue, actually, as well. The question basically is, how long do you believe the central banks can forestall the next financial crisis, and what tools do you think they might employ when it comes?
Yes, I think that having tried to answer this question for a number of years, which is what drove me to writing the book that's going to come out next year, Collusion, and really digging into the collusion, the collaboration amongst, in particular, the G7 central banks in ensuring that this policy has been ongoing, and that if, say, one central bank, like the Federal Reserve, raises rates a little bit or backs off a quantitative easing a little bit, then another central bank in that consortium, say the Bank of Japan, will increase their quantitative easing or decrease their rates. So in effect, you have a consistent global 0% interest rate policy and ongoing quantitative easing policy, even if one central bank sort of, takes their foot off the pedal for a little bit. And that's why it's been able to perpetuate for so long. It's not one individual central bank. It's a coordinated, collusive approach among central banks. And so can that continue? It has continued for 10 years. And I think at this point, even today, there was a statement, today there was a statement from European Central Bank head Mario Draghi. He didn't use that today in terms of the ability for the ECB to continue their monetary easing. But he also said that that's kind of a necessity, and that that he can't even give an indication of when it will end. I'm paraphrasing speeches on the ECB website, right. But so the guidance that these people are giving, as well as their actions, are indicating there's multiple years of this to come. I don't know what that means in terms of timing, but as I said in the answer to the prior question, because there's no external limitations on them, they can literally do whatever they want. There's no reining in. There's no voting them out. There's no changing those policies. And again, they're completely global. Mm-hmm. I say this is going on for at least a few more years, at least until these leaders change. And the change, we've got 2019 at the Bank of England. We probably will have Kuroda at the Bank of Japan continue on for a number of years. In China, the People's Bank of China, there's a little bit of a difference, but also that central bank leader has been in for an extended period of time. They're not quite involved in the G7 aspect of rates. They're a little bit outside of it. But for the most part, the people in power are going to stay in power. And even if the Federal Reserve here changes hands, say from Janet Yellen to Gary Cohn, as an example, as a possible Federal Reserve new chairman, he's pretty much indicated that he's on board with these types of easing policies as and when they're necessary. So if that happens, I don't see it ending for another, he'd be there for 8 years. So in that respect, continues a lot longer.
All right. Well, again, that's a pretty good segue to question 4. Given the central bank collusion and given that the big money center, if you want to call them that, or financial investment banks are kind of their right-hand men, what chance do you give the Trump administration for reinstating at least parts of the Glass-Steagall Act?
See, that's also, these questions are excellent. I got to say, Sprott people are on the ball. This is all really important stuff, and it's all connected. Glass-Steagall's interesting because it's a check to a large extent on the Federal Reserve System. And Glass-Steagall is kind of a counter to whatever might happen and when that might happen, because the idea of it is that it would separate banks from using their deposits and loans in the same bank holding company as they also create and trade other types of riskier, more speculative, or less transparent securities. And so the idea of bringing back Glass-Steagall, going back to the 1933 environment, as the National Committee put in their platform last summer, is something that I think actually has more consideration right now in the U.S. Congress under the Trump administration than it had in the last, just under the Obama administration. And I say that because of two things. One is I spent a lot of time talking with Congress people on both sides of the aisle on the issue of Glass-Steagall and the issue of a required reinstatement of Glass-Steagall to avoid the government or more central bank intervention to have to come in the event of another financial crisis where banks can again say, look, but we have deposits and we have your cash, and so therefore we need your help in the event of, whether it's a corporate default crisis or whether it's something geopolitical or whatever it might be, because no fundamental structural change has happened to the banking system. They are still, too big to fail institution in Europe, and the U.S., of course, the crux of the last crisis, and would probably between the U.S. and Europe be the crux of the next crisis. Bringing back Glass-Steagall, therefore, does have a certain attraction to Congress people on both sides, because it feels weird. It's really that simple. That's not a very sophisticated word, but it feels weird to a lot of these Congress people that we have had so much of a glorification of the stock markets and the bond markets, and everything's fine right now from a financial perspective, and supposedly the banks are all solvent. But at the same time, we have this ongoing policy. So even though, and I can tell you they're not all involved in finance or economics or anything individually, but the ones that are thinking about Glass-Steagall on both sides of the aisle are thinking about it from the perspective of, what happens if we have another crisis and we did nothing from the last one. Now, there's a lot of political ramifications on that because Democrats aspire to Dodd-Frank, which they say has fixed the problem, and I think that's actually dangerous because there is still risk in the financial system, as evidenced by so many things. And the Republicans have passed in the House the Financial Choice Act, which kind of does the same thing as Dodd-Frank, but they say it isn't, but tries to use capital reserve restrictions on banks as opposed to restructuring banks as a way to mitigate the potential risk in the future. And there's nothing wrong with capital restrictions. However, they are not going to help in the event of a real crisis. And what will help in the event of a real crisis, from ensuring that we have another, bailout and more doubling down by the central bank system, is to not have a connection between deposits and loans or commercial banking, regular banking with investment banking. That would mean banks would have to right now, let's say if it happened tomorrow, they would have to right now look at the risks that they're creating within their books, and not from standpoint of just capital behind them, because it's easy to put capital behind them right now. We've had cheap capital for 10 years. It doesn't require, it's not that big a deal. But to really do something where they have to take their own risk on for the more speculative endeavors that they do. And the other side of their books would be, continue to be guaranteed by the various governments, as we have here in the U.S. with the FDIC. So there is a bill right now. It's called H.R. 790 that's in the House. It has about 55 co-sponsors. It's a bipartisan co-sponsored bill and suggested bill that would reinstate Glass-Steagall. And I think that was 55 just in the first part of the first session this year. And I think that's going to grow substantially next session. Whether it gets passed or not, it's a very difficult act to pass because none of the banks want it to pass. But it's certainly something that is being looked at in Congress. So I think the potential is better now than it's been. Of course, if we do have a crisis, it gets even better. It'd be good if we could avoid that. But I think that's where we stand.
Fair enough. All right, I just have 3 quick questions for you to go. This next one has to do with Bitcoin. And do you see blockchain as the future? And do you think that the global central banks see cryptocurrency, Bitcoin, as a threat?
Well, I'll take the second part of that first, because they absolutely see anything that they're not in control of as a threat. So anything that's an alternative to the current existing monetary system, whether that's simply going back to some sort of a standard system with a portion to gold and even a portion to multiple currencies or whatever that might be, is a threat to the ability to control the flow of currency and the sort of more dollar-centric based system that we have now. So Bitcoin and blockchain have that potential, and they do concern central banks from the standpoint of do they increase in terms of usage? Well, they have. I personally, and this is slightly popular because I do think they're an opinion, because I do think central banks are, as I mentioned before, quite dangerous to stability in general. Well, unknown quantities from the standpoint of sort of security to regular people. I mean, they're an alternative currency, and they're an investable alternative as well from just the standpoint of, are they going to get used and just their own relative value. But I think for individuals, the fact that there isn't a clear form of recourse or regulations on them is also something to be concerned about. So it's an evolving element of alternative currency and an alternative system, and it is something, again, the central banks are afraid of. But I also think there's concerns I would have in simply turning it over without a bit more of a framework for recourse.
Got it. All right, just 2 more questions. You've recently spent some time in Japan. What do you think can be learned from Japan's experience over the last 30 years?
Well, from the standpoint of Japan, in the last 30 years, certainly they had, there's a couple of things that happened, right? They had a major financial crisis or banking crisis in the 90s. And then that kind of took a while to work its way through the system. But what they ultimately put in place were better regulations for banks within Japan. And and also government support for that. But that didn't necessarily help the economy. I mean, they still had a sort of slow growth in terms of their economic perspective. But they also did something in in the mid-2000s before the Fed did it, which was they instilled a kind of quantitative easing. They were sort of the first quantitative easing policy that came out in the world, which was to have their central bank, the Bank of Japan, inject money into the system to help the banks resurrect themselves, as well as to sort of maintain that support for the banking system. But they ultimately found down there's papers to the effect of this that stimulus itself didn't stimulate their economy. It merely it merely helped to an extent banks that were troubling. But what helped, I think, more so to troubled banks was the fact that they instilled a bit more regulation in terms of the types of risks they could take on, and that is something we could learn from. Now, of course, their quantitative easing model is very, very active. In fact, since Kuroda became head of the central bank a few years ago, the percentage of assets that the Bank of Japan holds on its books relative to the GDP of Japan is close to 80%. And compare that to the percent of assets that are held by either the Federal Reserve or the European Central Bank relative to their respective GDPs, where it's about 22 to 21%. So that's something I think will end very badly for Japan. So that's a lesson. That's something to watch, actually. I mean, it's ongoing. So that's something to watch in terms of a negative lesson. So the good lessons are in terms of regulations and sort of removing very sort of corroded or toxic assets off the balance sheets of the biggest banks, and a mini injection of quantitative easing at the time that didn't totally artificially change the markets. The negative, I would say, is continuing to examine what they're doing with respect to taking the quantitative easing model today to a nth degree. Right.
All right. Well, one last question for you, Nomi, and I guess we'll call this has to do with current events. It was just a couple of days ago that Secretary Treasury Mnuchin took a sudden trip down to Fort Knox in Kentucky to check things out there.
Right.
The first time a Treasury Secretary has been there in 40 or 50 years. What do you make of this? Anything?
I think that, to an extent, it was it was an interesting maneuver relative to gold, which has a couple of ramifications. I'm not sure why exactly he did it, but in terms of what it represents, we don't want, the Fed doesn't want, the U.S. Treasury Department doesn't want to have any sort of return to a gold standard. It's one thing to check, sort of in this bemused way, we're holding gold, does Fort Knox really have it, et cetera, which I think was a bit dramatic. But it's another thing to really have our holdings of gold or any major central bank's holdings of gold be something that the Federal Reserve, the U.S. Treasury Department, or anybody in the U.S. government would want to have as some sort of suggested future approach. So it was a weird kind of, I think, in that respect, visit. And his quip, I assume the gold is still there, before going out, sort of, points to that. So, I mean, it was interesting, but I don't think it's I think if anything, it's to ensure that there will be no policy that is ever suggested under him or really, under the Fed, certainly not under Gary Cohn, head of the Fed, that would put gold back into the mix of any sort of a reserve system or suggested reserve system.
Right. Well, Nomi, thank you so much. You've been very generous with your time, and I just think all of the answers you've given give a lot of people a lot of reason for thought. So thank you so much for visiting with us here at Sprott Money News and SprottMoney.com, and hopefully we can do this again sometime in the future.
Great. Thank you so much.
And to everyone out there, thank you for taking some time to listen, and we'll talk to you again next month.